2026 is not just the year the economy changes, it's the year money itself dies. Most Americans still think we're heading into a recession. They're dead wrong. What we're walking into is a full reset, not of just interest rates or inflation, but of how money works, who controls it, and who gets to use it. This isn't some abstract theory. It's already started. The central banks, the asset managers, the tech infrastructure, it's all converging right now. And if you don't understand what's happening behind the scenes, you're going to wake up one morning locked out of your own bank account permanently. So today, I'm walking you through the 10 stages of the financial reset, starting at the surface level and diving all the way to the bottom, where you'll see that this isn't about saving the economy, it's about replacing it. Let's start with number 10. 10. Real-time payment systems are the Trojan horse of the new dollar. So here's what no one's telling you: the financial reset won't arrive with flashing headlines and panicked press conferences. No, it'll slide in quietly under the radar, wrapped in phrases like convenience, speed, and innovation. And the biggest red flag that almost nobody's paying attention to? The rise of real-time payment systems. Let me explain. In July 2023, the Fed officially launched FedNow, a 24/7, 365 instant payment service that allows banks and credit unions to send and receive money in seconds. Sounds great, right? Who doesn't want faster payments? But here's the part they bury in the fine print. FedNow isn't just a payment system. It's infrastructure. It's the digital plumbing for a future where every dollar is tracked, time-stamped, and controlled. And this isn't just happening in the US. Over 130 countries are developing or piloting their own CBDCs, central bank digital currencies. And guess what they all have in common? They rely on instant settlement rails like FedNow or similar systems. The Bank of International Settlements even called real-time payments the backbone of programmable money. Now think about this. Once every transaction is routed through a centralized digital network, how hard would it be to enforce spending limits, or geographic restrictions, or even expire your money if you don't use it fast enough? China already built this into their digital yuan pilot money that disappears if not spent. The US won't be far behind. And if you think private banking apps like Zelle or Venmo are immune, think again. These are already being integrated into FedNow infrastructure. That's why banks like JP Chase and Wells Fargo joined the FedNow pilot program. The goal here isn't just efficiency. The goal is control. Once this is normalized, it's only a matter of flipping a switch to move from dollars in your account to tokens in a state-controlled wallet. The reset won't look like chaos, it'll look like a new app update. But once we go full digital, there's no cash to hide in. That's the real reason you need to pay attention. 9. Your bank is preparing to turn you into a node on their network. Now, I want you to imagine this: you're no longer a customer. You're a data node, a programmable endpoint on the monetary network. That's not a dystopian metaphor. That's literally how the next version of the financial system is being architected. In late 2025, multiple major financial institutions, including BNY Mellon, HSBC, and Citi, began piloting something called tokenized identity-linked wallets. What does that mean? It means your ID, your money, and your permissions all encoded into one digital token. You won't access your bank account anymore. You will be the account. Through biometric-linked identity systems and KYC-compliant digital wallets, banks are preparing to fuse your personal data with your monetary access. And here's the kicker. Once that system is in place, the money you use won't just be about balance, it'll be about behavior. Miss a payment? Your score drops. Buy something risky? Maybe your transaction gets flagged. This isn't speculation. This is exactly what Project Rosalind, a joint experiment from the Bank of England and BIS, concluded in 2023. Programmable money must be identity-aware to enforce compliance. In other words, no anonymous transactions. Ever. MasterCard, meanwhile, rolled out their digital transaction verification framework in Q4 of 2025, where every transaction has to pass a trust index tied to your digital footprint. And you thought your credit score was invasive? Try living in a world where your ability to spend money depends on real-time behavioral analysis. You might think this only affects big corporations or fintech nerds, but no. The reset is coming for Main Street. The infrastructure is being rolled out in the name of fraud prevention and anti-money laundering. But what it's really doing is turning every single dollar into a surveillance device. And when that switch gets flipped, your money will only work if you do. 8. The death of private banking. You just haven't got the memo yet. Let me say this as plainly as I can. Private banking is dead, not because they're collapsing not yet, but because the very concept of banking as you know it is being phased out. By design. In this new system, you don't need a traditional bank anymore, and they know it. That's why they're scrambling to reinvent themselves, not as custodians of capital, but as gatekeepers of access. Let's look at what's actually happening right now. As of December 2025, over 86% of all U.S. bank branches had reduced their hours or gone fully digital. Physical branches are vanishing and they're not coming back. Why? Because in a tokenized monetary system, your assets don't need safekeeping in a vault. They're held on-chain. They exist as data. That's why Citi launched its Digital Asset Node Network for institutional clients. Why JP Morgan Chase is running Onyx, its internal blockchain settlement network. Why BlackRock, Fidelity, and State Street are all now custodians of tokenized ETFs and stablecoins. The new financial model is, code holds your money and banks hold the keys. Which means eventually you won't even need a bank, you'll need authorization. And guess who writes the rules for authorization? That's right, the very institutions that are phasing out private banking in the first place. See, once everything is tokenized and on-chain, the wallet becomes the bank. And who controls the wallets? The issuers, which could be central banks, government partners, or approved financial intermediaries. Not you, not me. That means if you say the wrong thing online, your wallet can be paused. If you fall behind on a utility bill, your tax return can be automatically garnished. And if your credit profile changes, access denied. This isn't sci-fi. The IMF published guidance in late 2025 encouraging central banks to develop dynamic risk scoring for retail CBDC users. That's you. They're building a system where banking isn't a service you pay for, it's a privilege you qualify for. And if you don't qualify, you're out. Welcome to the reset. 7. The digital dollar will be a programmable prison disguised as convenience. Let me be very clear, the digital dollar isn't just coming. It's already in the final testing stages, and it's being wrapped in the warm, fuzzy language of innovation and inclusion. They'll tell you it's going to help the unbanked, that it'll lower fees, that it'll make government payments faster and more secure. But here's the truth. The digital dollar will not be money. It will be a policy tool. In March 2025, the Digital Dollar Project, backed by Accenture and the Federal Reserve Bank of Boston, completed Phase 3 testing of their retail CBDC prototype. That prototype included conditional payments, programmable expiration dates, and spending restrictions tied to merchant categories. In other words, if the Fed doesn't want you to spend money on beef or gas or ammunition, you won't. The system will simply reject the transaction. You think I'm exaggerating? Look at what's already happening in Nigeria. The Naira, one of the earliest CBDC deployments, included built-in limits on how much citizens could hold or withdraw if they didn't comply with biometric onboarding. And when Nigerians rejected it, their access to cash was throttled. ATM withdrawals were capped at $45 per day. That wasn't a policy glitch, it was a blueprint. The same is happening in China, where citizens receive their digital yuan with use-by dates and spend location restrictions. You can't save, you can't trade, you can only consume exactly where and when they want you to, and this is the same script that's being quietly adopted by Western democracies under the illusion of modernization. When the US dollar goes digital, it becomes fully programmable by the issuer, which means the money in your account is no longer yours. It's theirs. And it's only valid if you behave. Think about how fast the Overton window has shifted. A decade ago, we were shocked by mass surveillance. Today, most people willingly carry a tracker in their pockets. With the digital dollar, that same logic is being applied to money. You will carry it. You will spend it how they say. And if you refuse, you'll be locked out of the system entirely. That's not innovation, that's incarceration. 6. BlackRock and the Fed are quietly merging into one financial super entity. Most Americans still think the Federal Reserve is a public institution, that it's there to stabilize the economy, prevent inflation, and protect your purchasing power. What they don't realize is that the Fed is neither public nor independent, and over the last 36 months, it's effectively merged with BlackRock, the largest asset manager on Earth, creating something we've never seen before: a private public monetary engine with no accountability and unlimited reach. It started quietly during the 2020 pandemic crash when the Fed handed BlackRock the reins to execute its multi-trillion-dollar bond buying program. But that wasn't a one-off emergency move, that was the blueprint. Since then, BlackRock's influence has only grown. By 2025, they weren't just managing Fed-backed programs, they were setting policy recommendations, issuing guidance papers directly to Treasury, and embedding their Aladdin risk engine into central bank simulations. Let that sink in. The same company managing $10+ trillion in global assets is now running stress tests for central banks, including the European Central Bank, the Bank of Canada, and the US Federal Reserve. So now we have a private entity that manages your 401k, your pension, your ETF, and is also designing the monetary environment those assets live in. That's not a conflict of interest. That's economic colonization. And it goes deeper. In late 2025, BlackRock launched a blockchain division called Digital Core, designed to tokenize and manage Fed-issued digital assets. And guess who's piloting that infrastructure? The Fed itself. We are witnessing the outsourcing of the money supply to a private asset manager that has no voter accountability, no transparency, and global entanglements that stretch into every major central bank and sovereign wealth fund on Earth. That is not capitalism. That is financial feudalism. And when the reset happens, and the dollar is redefined as a digital token with built-in yield tracking and expiration, it won't be a policy created by elected officials. It'll be code deployed by BlackRock developers, rubber-stamped by the Fed, and enforced by whatever administration is in power. The line between public monetary authority and private financial empire has already been erased. You just haven't been informed yet. 5. The collapse of the bond market will trigger a forced digital migration. What happens when the single most important market in the world, the US Treasury bond market, becomes unbuyable? That's not a hypothetical. That's where we are right now. By the end of 2025, the US was paying over $1.1 trillion per year just in interest on the national debt. That's more than we spend on defense, more than Social Security. And here's the issue. Foreigners are no longer buying our bonds. Japan and China, once the largest holders of US treasuries, have been aggressively offloading their holdings since 2022. As of Q4 2025, Japan's holdings dropped below $1 trillion for the first time in over a decade, and China's are under $800 billion, a 30% drop in just 4 years. Why? Because they don't trust the dollar anymore. And who's picking up the slack? The Fed. Through indirect purchases, backdoor repos, and rolling maturities, the Federal Reserve is now the single largest net buyer of US debt. That's monetization. That's printing money to buy your own IOUs. And the consequences are catastrophic. Yields are spiking, liquidity is vanishing, and confidence is collapsing. This is exactly what happened in the UK in 2022 when the gilts market imploded and the Bank of England had to step in to stop a pension collapse. Now scale that up to the global reserve asset, the US Treasury. If demand collapses, and it's already collapsing, the only way to fund the government is to create money out of thin air. And that's where the digital dollar comes in. Because in a digital system, the government doesn't need to issue bonds. It can issue tokens, directly, instantaneously, with yield baked in. No middlemen, no markets, no trust required. This is called monetary streaming, and it's already being tested by the Bank for International Settlements under Project Agora, a framework for streaming government obligations via smart contracts. So the end game here is clear. Collapse the legacy debt market, replace it with programmable digital obligations, and reset the rules of who owns what and why. The US bond market isn't just dying. It's being euthanized to make way for a fully controlled, tokenized, centrally managed monetary grid. That is the reset. And it's already in motion. 4. The end of bank deposits. Your money is becoming a liability they don't want. Here's what almost no one understands in the new financial system that's emerging right now. Your bank deposit is no longer an asset the banks want to hold. It's a liability, and they're quietly preparing to dump it. I know that sounds crazy, but follow the incentives. Since 2022, bank deposits in the US have fallen by over $1 trillion, the largest drop in American history. Banks don't want your money, they want control over flows, not balances. Why? Because holding your deposits costs them more than it earns. Thanks to higher interest rates and tighter capital regulations under Basel III and the Fed's own liquidity coverage ratios, deposits are now expensive to insure, manage, and lend against. Meanwhile, new systems like tokenized treasuries, stablecoins backed by real-world assets, and on-chain repo markets are offering banks and institutions higher yields and lower risk, completely bypassing the traditional deposit base. JP Morgan's JPM coin now settles over $1 billion per day, not in client deposits, but in tokenized dollars that operate outside the legacy system. And once the central bank fully rolls out a digital dollar, banks won't need your deposits at all. The money will live on the Fed's balance sheet, and commercial banks will act more like front-end service providers managing wallets, offering analytics, and tracking behavior. In other words, you'll think you're banking, but your funds will be housed in programmable Fed tokens, not in the traditional fractional reserve system. And here's the part that should chill you. These new tokens can be restricted, monitored, and even clawed back. That's already being explored in Europe under the ECB's digital euro framework, where wallet limits, daily transaction caps, and real-time surveillance are written into the code. The US isn't far behind. When your money becomes software, it can be patched, paused, or erased, and the illusion of ownership disappears. So if you're still treating your bank account like a safe, like it's a vault that holds your value, you're already behind. The reset has already begun, and the banks have decided they don't want to hold your dollars. They want to rent you access to the system they control. That's the new model, and it's not optional. 3. AI will enforce the new rules of money, and you won't be talking to a human. Let's make one thing very clear: when this reset is complete, you're not going to call your bank and speak to a human being about a frozen account or a suspicious block on a transaction. You're going to be talking to an AI-driven risk engine that has already made a decision about your access to money based on thousands of invisible parameters. That's not science fiction, it's already here. In 2025, several major banks, including Bank of America, Citi, and Deutsche Bank, fully transitioned to AI-based transaction vetting systems. These systems don't just flag fraud, they evaluate behavioral patterns, social data, political affiliations, and even location data to determine whether a transaction should be allowed. And because the entire financial stack is being digitized and tokenized, every action is recorded and processed in real time. You won't get a warning, you'll just get declined. Worse, you won't know why. That's because these AI systems are black boxes built on machine learning models that don't provide explanations. The banks and central banks call it risk optimization. What it really is automated exclusion. And once money is programmable, the conditions for using it become algorithmic policy tools. Did you share misinformation online? Did you attend the wrong rally? Are you behind on your carbon usage quota? Yes, that's a real thing being tested in Canada and the EU. Suddenly, your access to funds is throttled. You're given a 72-hour restriction. You're forced to call a help desk that routes you through layers of bot interfaces. But guess what? The AI already made the decision. You're flagged. Welcome to the automated compliance economy, where your money listens better than your dog. Now layer in what's happening with ESG and DEI scores being applied to individual users, not just corporations. Your spending history, your search history, your voice all become data points in your risk profile. And that risk profile determines what you're allowed to buy, how much, and when. This is how AI becomes the financial enforcer of the digital reset. The face of your new financial reality isn't a banker in a suit. It's a silent algorithm reading your life like a book. And once that book doesn't match the narrative, you're out. 2. The reset ends with one thing: a system where you don't own money, you access it. Here's the part that most people still don't understand, even if they're awake to everything else. The financial reset is not about replacing paper with digital. It's not about modernizing payments. It's not even about blockchain. The reset is about something far more fundamental: the shift from money as property to money as permission. That's the destination. That's what all roads lead to. In the old world, if you had cash in your hand, you owned it. No intermediary, no approval layer, no behavioral scoring system. It was final settlement. But in the new system being rolled out right now, money becomes something you don't truly possess. It becomes something you are allowed to use under conditions. Think about what's already happening. Banks freezing accounts without court orders. Payment processors debanking people overnight. Governments pressuring financial institutions to enforce policy through access. And once this becomes fully tokenized, it becomes automated. Your balance won't be a pile of dollars you own. It will be a ledger entry you can access as long as you remain compliant. The IMF has openly discussed in its 2024 to 2025 working papers the concept of conditional liquidity, where retail CBDCs could be programmed for specific economic outcomes: stimulus spending, restricted savings, targeted consumption. That's not conspiracy language. That's official policy language. And the Bank for International Settlements has repeatedly framed the future of money as a system of authorized intermediaries enforcing rule-based access. That's the key phrase: rule-based access. You're not holding value. You're interfacing with a network. And networks can revoke users. That is the real difference. In a tokenized system, money can carry identity, rules, expiration, and surveillance metadata. It can be geofenced, it can be throttled, it can be made unusable for certain categories. That means money becomes less like cash and more like a subscription service, valid only while your permissions remain active. This is why physical cash is being quietly phased out. This is why bank branches are disappearing. This is why the next system isn't being sold as control, it's being sold as convenience. But convenience is the sugarcoating. The core transformation is simple. They are building a world where wealth is not owned privately, but allocated through access. And once you understand that, you realize the reset isn't just financial, it's civilizational. 1. The final step: one unified ledger, where every asset, every transaction, and every person is accounted for. And here we are. The real number one. The end of the road. The final form of the American financial reset is not a digital dollar. It's not tokenized deposits. It's not even AI enforcement. The final step is this: a single, unified financial ledger, where everything is connected: money, identity, assets, behavior, taxes, debt, compliance, all in one programmable system. This is the holy grail central banks have been chasing for decades. Total settlement, total visibility, total integration, and it's not a future concept anymore. The BIS is already running Project Agora. The DTCC is tokenizing securities infrastructure. The Fed has FedNow. BlackRock is tokenizing real-world assets. Major banks are building blockchain settlement layers. These aren't separate trends, they are converging into one architecture. A world where all value moves on rails that are centrally observable and controllable. Imagine a system where your paycheck arrives as a token. Your rent is auto-deducted through smart contract priority. Your taxes are withheld instantly. Your spending is scored in real time. Your savings are limited by policy. Your investments are held in tokenized custodial wrappers. Your retirement is accessible only under conditions. That is not fantasy. That is literally the framework described by central bank researchers under terms like integrated ledger finance. The Bank of England has published papers describing a future where CBDCs interact directly with tokenized asset markets, housing, bonds, equities, all settling instantly on the same ledger. And once that happens, the financial system stops being a marketplace and becomes an operating system. And operating systems have administrators. The reset is not about collapse. It's about consolidation. It's about moving from messy private ownership into clean, programmable control. And the reason they're doing it now is because the old system is mathematically unsustainable. $37 trillion in debt, exploding interest costs, collapsing confidence in treasuries, de-dollarization pressures, geopolitical fragmentation, and the need for tighter control over capital flows. They can't patch it anymore. They have to replace it. So what comes next is not a crash. First, it's a rollout, a migration, a forced upgrade. And most people won't realize what happened until they wake up one day and discover the financial world is no longer something they participate in freely, it's something they are inside of. Like a cage you can't see because the bars are made of software. That is the reset. And that is what happens next. So, what do? That's the question I get the most. And I'll tell you first, stop playing by the old rulebook. That thing is ashes. If you're still depending on your bank account like it's a vault, still holding only dollars, still thinking inflation is the worst thing that could happen to you, you're sleepwalking toward a cliff. The new system is already here. It's opt-in at first, but that window is closing fast. So my advice? Get educated. Start converting a portion of your liquid assets into hard stores of value, physical gold, silver, land, diversified global currency. If you're tech-savvy, start learning how to hold custody of real assets, tokenized treasuries, stablecoins backed by reserves, or yes, even crypto, if you understand the risks. And second, build redundancy. Not just financial redundancy, life redundancy. Where you live, how you work, how you store value, how you interact with the system, all of it needs to be reassessed in light of the fact that we are walking into a programmable, rule-based monetary system where access can be denied for any reason. That's not paranoia, that's planning. Look, I don't make these videos to scare people. I make them because I'm a husband, a father, and I've seen firsthand how fast a system that pretends to work for you can turn against you. If you've got kids, you don't get to sit this one out. So if this helped you, share it. Subscribe. Drop a comment with what your family is doing. Let's build a community that doesn't just survive this reset, but gets ahead of it. Because if we don't start talking now, if we let them reset the system while we're asleep, we'll wake up broke. Worse than broke dependent. And I refuse to let that happen to my family. I hope you won't let it happen to yours. Until next time, stay sharp, stay sovereign. I'm finance economist, and this was They're About to Reset the American Financial System. Peace.